Hey guys, it's Nick, and in this video I want to talk about what is going on at Robinhood. If you are a Robinhood account holder, you're going to want to check out this video. Now, the problems at Robinhood started yesterday with them blocking access to trading Gamestop and some other stocks. They reversed that last night, but then today they changed that again to limit you to only being able to buy 2 shares of GameStop and some other stocks. Now, after the close at 5 o'clock, they've changed that list to include 36 stocks, including Starbucks, where you can only buy 1 share of stock. What the hell is going on? Are they in trouble? Do they need money? Is this all caused by GameStop and the additional margin they need to put up? So let's get into it. On Thursday, the Robinhood CEO, Vlad Tenev, was on CNBC and saying that he and his firm had acted preemptively in cutting off certain trades and cashed out some customers' positions, attempting to make clear that the firm didn't really need any liquidity. Also, he talked about the rumor that maybe they cut off the trading in GameStop and other shorted stocks at the behest of hedge funds. And he said, "We absolutely did not do this at the direction of any market maker. The reason we did it was because Robinhood is a brokerage firm and we have lots of financial requirements, including the SEC Met capital requirements." But just last night, the firm reportedly drew down a credit line from 6 banks amounting to between $500 and $600 million to meet higher margin or lending requirements from its central clearing facility for stock trades known as the DTCC. But apparently that wasn't enough, and New York Times reported that Robinhood still needed more cash quickly to ensure that it didn't have to place further limits on customer trading. And so apparently, Robinhood went to 2 venture capital firms, Sequoia and Ribbit Capital, who came together on Thursday night to offer their emergency funding, 5 people involved in the negotiations said. And here, Zero Hedge said, the Robinhood CEO appears on CNBC, Bloomberg, and CNN, says has no liquidity problems. 2 hours later, it raises $1 billion in new capital from investors. Now, this article actually agrees with the claim that Robinhood didn't shut down GameStop trading just because market makers or hedge funds told them to. They said it was because of the exchange rules. It was entirely about market dynamics and clearinghouse deposit requirements. And other brokerages like Charles Schwab and Ameritrade said the same thing. Neither Schwab or Ameritrade halted buying or selling of any stocks this week. Neither firm restricted buying or selling basic options. Both firms did adjust margin requirements on select stocks to ensure clients had sufficient assets to pay for stock purchases. So not everybody knows, but when you buy a stock, it takes 2 days to clear. So the brokers have to put up the money for a few days while the transactions settle. So Bloomberg says it's not really Robinhood doing nefarious stuff. It's the DTCC saying this stuff is just too risky. We don't trust that these guys have the cash to be able to withstand settling these things 2 days from now. Because in 2 days, who knows what the price could be? It could be zero. The DTC wouldn't say how much they required from specific firms, but they did say that requirements jumped to $33.5 billion, up from $26 billion. So the requirements of margin that the brokerage had to put up had increased. That goes for Robinhood, that goes for Schwab, TD Ameritrade, Interactive Brokers, all of those guys. On the Zero Hedge article, they talk about what happens when a customer trades on Robinhood. So a Robinhood customer buys and sells stocks. Those trades don't settle until T plus 2 days later, meaning trade date plus 2 days later. And depending on the net of buys and sells, Robinhood is on the hook to pay or receive that net cash. That's credit risk. The NSCC is the main entity that takes care of the credit risk. And so they are required to do this by the SEC rule, tracing back to the Dodd-Frank law. And how does the NSCC clearing deposit get calculated? Here is the calculation. Okay, deposit equals minimum of 99% to D value at risk, plus gap risk measure, deposit floor calc, plus mark to market, blah, 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 all that stuff. And it gets worse, because if any one stock nets more than 30% of the net buy sell, then we take 10% of that amount and add it to the gap risk measure. So that means that if everybody's piling into just one stock like GameStop, that even increases the margin requirement they have to put up. Now back to Robinhood's problems of restricting people from buying stock. Is it because they don't want to encourage the short squeeze, or because they are having financial problems with the margin requirements? So here at 1:30, Zero Hedge published this article, and here's a screenshot saying people who are trying to buy GameStop are limited to just 2 shares total. And here's a screenshot. It says, this order will exceed the maximum allowed GME shares you can hold at this time. You currently have 3 shares purchased or pending, including this order, which exceeds the limit of 2 shares. So now you can only buy 2 shares, okay? And this was at 1:30. And the limits were American Airlines 55, AMC 25 shares, BlackBerry 25 shares, Bed Bath & Beyond 30. So GME, GameStop, 2 shares you can buy. But that's at 1:30. Now at 5 o'clock, it's now gotten worse. So what is going on? So here at 4:59, Robinhood has changed how many shares you can buy, even after they took down their credit lines and got a $1 billion rescue capital investment. So something is really wrong at Robinhood right now. Robinhood made this announcement that going forward, customers will be subject to maximum aggregate limits in 50 securities, of which 14 are capped at position limits of just 5 shares, while allowing total holdings in 36 securities to be just 1 share. In other words, at this moment, no client is allowed to own more than 1 share in names like GameStop, AMC, AG, BBY, Beyond, Workhouse, and others. And even boring low vol names like GM and Starbucks are limited to just 1 share. So here's a table of the maximum number of shares and options contracts to which you can increase your positions. Please note that these are aggregate limits for each securities, not per order limits, and include shares and options contracts that you already hold. These limits may be subject to change throughout the day. So in other words, if you own 1,000 shares of American Airlines, they're not going to make you sell 999 shares. But going forward, if you want to buy more shares, you can only buy 1. Or actually, you can't buy any because you already own more than 1 share. That goes for all of the rest of these stocks. AMC, AMD, BB, BBY, Beyond, EXPR, GM, GameStop, I mean, COS, Naked, Starbucks, 1 share. So here it says, panicked clients who are wondering if this means that their current holdings, which exceed 1 laughable share, will be forcefully liquidated, can breathe for now. The company said that outside of our standard margin-related sellouts or option assignment procedures, your positions will not be sold for the sole reason that you are currently over the limit. However, you will not be able to open more positions of each of these securities unless you sell enough of your holdings such that you are below the respective limit. In other words, if you have 1 share and want to buy more, you have to sell that 1 share to be down to 0 shares to be able to buy 1 more share. Great, right? The company also disclosed that no fractional shares can be bought going forward, as fractional shares are currently position closing only for all the securities listed in the table above. This means that you can sell and close your fractional positions, but you can't open new fractional positions. However, you can still open a whole share position according to the limits listed above. So why is this all happening? The most likely reason is that DTCC clearinghouses and other regulatory agencies, Robinhood was found to be in another capital deficiency position, even with the billions raised overnight, and it is being forced to de-lever. So this means that Robinhood, as of this moment, is possibly scrambling to obtain even more capital, although we somehow doubt it will be just as easy to take from the rich as it was late last night, especially since the client exodus is surely accelerating. And some people are saying maybe we're going to have another Lehman Brothers weekend situation on our hands. Who knows? So if you're a Robinhood account holder and you're watching this and you think maybe you're worried that maybe they're going to go bankrupt or something along those lines, I'm not trying to cause a run on Robinhood or anything like that. And there is so-called protection on brokerage accounts. It's not FIDC insurance like bank accounts. It's called SIPC, and it is not a government insurance fund. It is a federally mandated, nonprofit, member-funded insurance fund. So the SIPC provides insurance coverage up to $500,000 of the customer's net equity balance, including up to $250,000 in cash. That doesn't mean that if you have $500,000 in stocks and the stocks go down that you're covered. You're not. It's just the money that you have in there. So guys, what's going to happen to Robinhood? I don't know, but I'm telling you, it's not looking that good, because yes, they have increased margin requirements from the increased volatility of Gamestop and these other highly shorted stocks. Their volatility is through the roof, especially the options. GameStop options have like 800% implied volatility, and Robinhood trades like the most options out of anybody. So their exposure to the options is really big. So they definitely have a lot more money to have to put up because of the increased margin requirements from the clearing company. For them to borrow another $500 or $600 million from their banks, and that's still not being enough, and then going and getting another $1 billion from outside investors, and that apparently is still not enough. So they are still lowering how many shares you can buy even after that $1 billion investment. So how much are they really short on this margin? And for them to be doing this and increasing the list of stocks that you can only buy one share or whatever, they know that they are really angering a lot of their customers, but it seems like they're thinking they'd rather cut off their arm than, die. And so they would rather piss off a lot of customers in the hopes that they're going to survive this than not do that and possibly not open up in the future. Who knows? Now, I'm not trying to start a run on Robinhood or any other brokerages. These brokerages have SIPC insurance, so you're supposed to be covered for your balances there. So I wouldn't worry too much about that, but restricting your ability to trade is a problem. If you went to the car dealer and you tried to buy a Toyota Camry and he said, yeah, this car is great, but you could only drive it 1 mile an hour, are you going to buy that car? No, you're going to go someplace else and buy a car that could drive the amount of miles you want to go. So there's going to be a lot of people leaving Robinhood for other bigger brokerages that also have zero commission trades as well now. So guys, I said this in a lot of videos. I don't really trust any brokers. I like a lot of them, but that's why I have multiple accounts, and you should too. Just in case something like this happens in one or two of your brokers, you have another one where you can still execute trades and maybe do an offsetting trade if you can't access your other broker. So always have a few options because you don't know what's going to happen these days. So guys, if you like this video, hit the like button, and I'll see you on the next one. Thanks for watching.